And a very warm welcome to everybody. I'm Pramod Panda, the Senior Program Director of CAFRAL. We are doing our first webinar in the series that we have planned for this particular time when we are undergoing this COVID stress and a lot of dislocations in professional work in different ways, affecting different organizations. So we have pulled back our resources, and we have thought that why not start the webinar series, and that is how we ideated this. And we would be today in another 60-75 minutes doing a webinar on credit risk assessment in post-COVID times. This is particularly coming up in the context of the fact that the pandemic has rendered rating and risk assessment system inadequate. Even if I do not say it has rendered, I might say it is potentially going to render the current rating and risk assessment system inadequate. Post-COVID, certain new ways of rating and assessing risk might evolve. Already, some changes are taking place. They have taken place. So the question is, what is the evolving shape of things? In that context, we thought of reaching out to one of the most experienced and technically sound person, Dr. Anil Kishora, former DMD and Chief Risk Officer of State Bank of India. We reached out to him and requested him about this. He readily agreed. I want to thank him a lot for this. So he's here with us this evening. He will be making both a technical and general presentation on this issue. As I said at the beginning, this is the first webinar that we are launching, we are doing. And we are extremely delighted to see that we have 225 registrations for this particular webinar. And we are amply encouraged and motivated by this sheer number that has registered. So I'll not take much time. May I request the Interim Director of CAFRAL, Mr. Chandan Sinha, to make the initial remarks, introductory remarks for this webinar. Over to you, Mr. Sinha. Thank you very much.
The kind of the surplus liquidity which exists, it may not be, it's not possible for banks to simply sit on idle, liabilities for very long. Sooner than later, they have to pick on certain credit proposals and have to kind of lend. Now, coming to some of the specifics, that the debate is around, at the current juncture, based on what is my experience and what I've heard from others, is, trying to make kind of a distinction, when you lend based on, whether it's a pre or a post-COVID stress. So people, of course, would like if there was a clarity between pre and post. So post-COVID, of course, is acceptable, and to that extent, willingness to help. But if something was, predisposed or was there from before, how to deal now, because that has got, in a sense, far more accentuated. Then there is an issue of, trying to figure out whether it's a liquidity issue or whether it's a solvency issue. The liquidity issue, yes, easy to deal with, and of course support is forthcoming. But solvency issue, I think that really deters bank. Again, not very easy to distinguish between the two, because the liquidity issue can, move into a solvency issue. And of course, there is this philosophical issue about, do we really lend to, to units of firms which are likely to become unviable given the change in the post-COVID scenario. So there's a lot of debate, not so much in India, but at least abroad, about what is, called zombies, So they just exist, and they absorb credit, but actually, sooner than later they would die, and they are not really adding to any adding to any growth or GDP to that extent. So that's a higher level philosophical thing. We may not address that at this point of time. And another issue is, of course, do we lend on an ad hoc basis? So like each bank does his bit, because there are schemes. So each bank, decides that, okay, 200, 300, I provide that assistance. Or should it be kind of a holistic funding where, the needs of the unit is kind of, appraised at the banking system level, and then each one, kind of contributes, each bank contributes its share in it. So that would seem to be a more rational way of doing it, because otherwise, if it's done in a piecemeal or ad hoc fashion, you might have given extra money, but which is not sufficient, and therefore, in due course, I think the NPA's size would actually be bigger if at all it does not work. So that's another issue. And then you also have to look at, how best to kind of, fit them into the government scheme. So there are a lot of government schemes, and therefore, which unit should, be, done under the TLTRO, which should be done where there's a credit guarantee, which should be, so these are also some of the issues which are coming up, or whether partly it should be done under one scheme or partly it should be, placed under some other scheme. That's again is one. Also, there is an issue of whether we are actually just going to provide a short-term assistance or a long-term assistance, which is essentially for viable units or sustainable, the units which will be sustainable, they can still be appraised for a long-term kind of an assistance. Otherwise, maybe it's just a short-term, and then down the line, 6 months from now, take a fresh look, and then you decide about whether the viability or the sustainability of that firm. So these are some of the questions which are arising. Of course, the time is very short. The pressure to do things is quite a bit. So I don't think everybody can go through a full process before they can actually take a call. But certainly these are some of the things which need to be kept in mind. So with this small background, I would actually invite Mr. Kishora to give his perspective on how he sees this issue of credit risk should be tackled by the banks. So Mr. Kishora, over to you, please.
Good evening. I'm thankful to Mr. Sinha and Mr. Panda for organizing this webinar. And Mr. Sinha has very, very beautifully laid out all the issues that we bankers are facing on a day-to-day basis. And I'm sure all of us who have joined into this webinar are tackling these issues in their own ways in accordance with the guidelines of the RBI and their own policies. Now, let me start here by highlighting something that we all know. COVID-19 or Corona has brought to us a major tipping moment when actually decades have happened in days. What would have taken decades to happen have actually happened in few days. And the course of both economic and social trend has altered, probably for good, probably for the next century. And the crisis, yes, it is a big crisis for the economy, for the society, all of us. But this crisis has done what perhaps neither Kyoto Protocol, which you remember it was signed about 15 years ago, nor Paris Agreement, which was done 5 years ago, could do for the planet. So in terms of change in the trends, probably it's a huge milestone. If we go back and we find that human focus globally historically has been on growth and development, all through. Actually, ever since the steam engine was discovered or invented towards the close of the 17th century, we have been pushing for more and more growth. Later, about 3 centuries later, internet was economy came up, and now we have IoT, etc., making us believe that finally there would be no limits to growth. Now, this corona outbreak has probably met that assumption quite a bit shaky. We are not sure of that any longer. And this has created huge uncertainties and unique challenges for the banking industry, for all of us. Who do we lend to in this environment? How much do we lend? These are the issues which are basically bogging us down. Now, let's go through the presentation. The first slide, which sets the context, Mr. Sinha has already kind of covered all these areas. Let's look at it once again. This event is a black swan with two heads, health and economy. Now, it is difficult to imagine the economic black swan getting tackled unless we are able to tackle the health issue as well. So there are two sides. Unless we find some solution for the health element, for the health component, it's difficult to imagine that economy can bounce back. So it's a double whammy, as Mr. Sinha said. Now, can we time box this event? Very, very difficult, because we really don't know how long it's going to take. And more importantly, it's not a temporary hiatus, not a temporary break. It could lead to people changing their preferences. Social preferences could change. For example, let's say there is a trend towards urban migration. All of us from the hinterland want to come to mega cities and stay there. That was till yesterday, till COVID happened. Now, people might think whether to live in these matchboxes, when they call it 2-bedroom, 2.5-bedroom apartment, but basically matchboxes. Now, people might decide against that, and they might want to live in the hinterland. Again, this will have consequences for the entire banking industry. Now, for a moment, let us look at the situation before the pandemic hit us. What was the situation? A state of corporate debt. It was elevated. Ballooning corporate debt, escalating retail borrowings, and easy money have been kind of ruling us for quite some time. And with its own consequences. In fact, 2008 global financial crisis, the central banks have started doling out a lot of easy money as a cure for that crisis. And that has more or less continued till date, till we hit this another crisis. Unfortunately, or rather differently, this time it is the real economy that is impacting the financial economy, not the other way around. So there are broader issues here, and how society will react to it, how social preferences will change, so all of that. But more specifically, because of this high corporate debt, easy money driving up asset prices, whether you look at the stock exchange or real estate market, prices were really hitting the roof. And we bankers were funding it. And we always believe that retail is safe. Now the question is, how much safe? The question we need to ask is, this corporate, SME and retail, these are the major divides major mental categories we make. Aren't these part of the same economy? If the corporates don't do well, if they don't buy from SMEs, if people are not employed, how are we going to get our EMIs back from the retail borrowers? So that's another issue. And retail is safe only to the extent individual jobs and incomes are secure. With businesses going under, how are we going to pay our EMIs? With asset prices dipping, will our retail borrowers retain the same incentive to keep up with EMIs? If yes, how long? So these are the broader issues which we really need to understand. And because of the impact of COVID, because of the lockdowns, because of so many issues, the impact on many of the companies is going to be very, very severe. And the general opinion is that the bracket, triple B bracket, which is just that kind of holy territory where we call our rated loans as investment grade, that could expand. And this could be prone to downgrades. And in case there is any difficulty in refinancing them, that could lead to consequences for the entire economy. Then we have this contracting economy. All the projections indicate that the global economy, Indian economy included, we are going to, in some ways, contract. Some ways, some of the economies might grow a little, but still, it's going to be a recession ahead. We have heard that old saying that when the tide is good, all boats get lifted. So the reverse is also true. If the tide is not good, many boats may refuse to lift. So how much money can be pumped into corporates to keep them alive, to keep them aloft? And Mr. Sinha used the word zombie companies. Yes, some of them are real zombies and you can keep them on the ventilator, but for how long? And finally, in all this mess, in all this maze, risk models, all of us have been creating risk models to assess the credit risk. And with historical PDs, LGDs collected over decades, that may not be the best roadmap any longer. Because the historical data may not be in a position to predict what's going to happen in the future. So how do we handle this? How do we go about it? That's the next question. So let's look at the impact. And that's in the second slide. So how I look at it, entire economy, if you are examining or assessing any business, any sector, any corporate, there are three kind of things to remember. Broken business. Broken business is where the revenue is kind of has dried up, has reduced. So what I have said is P&L gone with the wind. Now the profit and loss, you don't have there. You have your cost structure, but revenue is not there. So these are the units which probably, if you give them some money, survival money, they would be in a position to bounce back. Then there could be others where the balance sheet itself is broken. Balance sheet, what do I mean by a broken balance sheet? You all know that balance sheet has strength. What balance sheet strength comprises? How much is the equity? What kind of debt is there? What kind of earnings potential, etc., etc. Whether they have the capacity to hold on, to survive. So some companies which have cash on their balance sheet be in a position to kind of maintain that their balance sheet is not broken, they have taken a hit, but they are well positioned to survive. And then there could be industries or businesses where the business model itself is broken. In case we lend to these companies in the hope that they will bounce back, it might turn out to be a case of no exit play. I think it was a French author, a French playwright who wrote this no exit. You really don't have any exit when the business model is gone. We remember Kodak days. Kodak used to be a dominant player, but Kodak, because the business model was broken, there was no buyer for it. Same with these video outlets we had in every city. There were rental agencies who used to give you videos to play at home. That business is gone. Today I was speaking with an expert in London, and what he said that all the gyms are virtually on the verge of closure there. Because during this time, COVID time, people have started doing workouts at home, yogas at home, going out for a jog in parks, etc. And now probably people are in no mood to go back to gyms. So the business model may be broken. And what is more bothersome, that a broken business may transition into a business model that is broken. There is one movie theater company incorporated in India. Sometime back, their CEO was on the CNBC channel. And what he said, that even though the theaters are closed, he would be able to survive because he has some few thousand crores on the balance sheet, and the balance sheet is not broken. Imagine that he is able to survive for 2 months, 3 months, or 6 months. What happens if the COVID is not time boxed in a period of 3 to 6 months and it goes on for a year or so? Obviously, the company will not be able to survive. Worse still, in case people feel that it is easier to watch movies on Netflix or similar platforms, what will happen? The business model may go for a toss. So this transitioning, which is very much possible, depending on how the social mores and social preferences evolve, how individuals react to it, that's going to determine whether a broken business will turn into a broken business model or it will bounce back. Now, all is not lost. There are silver linings as well. Now, this GSC stands for Global Supply Chain, as you might have guessed, and Global Value Chain. So it may shift to India's benefit. Now, there is a talk about China plus one. As we all know, China is the manufacturing hub for the world. It used to be said that India is the service hub for the world. Now, everyone is trying to kind of move towards a new system, a new approach of China plus one. What has it done? You might have seen a few days back, some data came where it says that last year, Japan invested about 10% of its overseas investment in China, which means 90% of Japanese investment last year went to other countries, which could be including India. Look at Taiwan. Taiwan used to be overly invested in China. Last year they invested 38% or 36% of their overseas investment in China. So about 60% plus went to other countries. So in case some of our companies, and I'm sure some of our SMEs, some of our auto part manufacturers, if they are able to join this global value chain and global supply chain quickly, those are the industries where banks can lend without much of a risk if they find that the onboarding to the global supply chain or global value chain has happened more or less seamlessly, more or less smoothly. So that's one area where I think we can see some good silver lining and where there could be some opportunities as well. Now, in terms of how to assess credit, let's go to the next slide and see what can be done. I have named it a Hitchhiker's Guide to the New Galaxy. Actually, it's a completely new world that we are living in. I would not hesitate to even add that the Basel framework, which was designed in the wake of previous calamities and crises, was probably designed for a different world. And now, perhaps we'll need to revisit it. Now, how do we survive and prosper under this new normal, as they say? First thing I would recommend is let us be back to fundamentals. It's time to look behind and beyond numbers. It's no longer the case where you develop a model, a scoring model or any other model and just mindlessly apply it. So you need to look behind and beyond numbers both. Why so? Because whatever numbers you get, let's say you get the numbers for March 20, is it a good guide for 21? I would say it's not. How do we kind of crystal gaze and find out whether we are lending to the right unit, to the right industry or not? Second thing is industry and sector risk. Very important to look at the industry and sector risk. Which sector are we going to finance? Multiple sectors, let's say even power. Power sector is there. If power consumption is going to go down, is it a good sector to finance? Again, let's look at coal-fired or thermal power stations. You would be knowing that recently Germany and UK incidentally were in the forefront of coal mining. And these people, now Germany has entered into some kind of agreement with various states, German states, that coal will get phased out. They will not use coal. So that kind of a scenario, and with more efficient plants, etc., coming up, all this needs to be studied, and we need to study the industry level, sector specific risk levers and focus on them. Now, another area is health of supply chain and value chain. How is the supply chain or value chain doing? Is it broken? Is it possible to repair? Is the unit left out of it, or it's still integrated? These are the areas we need to, or credit analysts would need to review. Demand, where are the buyers? Is it domestic? Is it overseas? How is the logistics? Will the company be able to export? And demand requires people flow. So the demand theoretically could be very high in India. If the demand was there 4 months back, it should be there even now. But there is no people flow. So all our malls are closed. So we need to look at that. Operational efficiency, how much capacity is in use, what is the cost structure, and other metrics. Now, equity and debt mix, very, very critical now. And here, let me take the example of what we call lease rental discounting. Lease rental discounting was considered till recently a very safe kind of bet, because in case of lease rental, you assume that rental is there and you are simply discounting it for a number of years. Now, what are the risks now? In the changed circumstances and in the post-COVID world, whether people will actually need so much of office space itself is in doubt. We public sector banks, we never used to operate from remote offices, etc. Now we are also getting used to it. Private sector has already been doing that. So this could pick up a steam, and then, and what happens? All this LRD, there is a risk that the lease may not get renewed, or the lease rentals may get negotiated downwards. And finally, as we have seen, these people used to borrow, there would be top-ups on that. Now you top up, use that money probably for funding new requirements of equity for new projects. Will there be so much demand? Do we have visibility into their end uses? So these are the issues which we'll need to ask, and we'll need to look at the quality of the equity which is being used or which is being developed. Earlier, we were very comfortable with things like quasi-equity, etc., etc. Whether that's still the model, all risk professionals need to think about it. Finally, scenarios versus linear thinking. Now, the kind of uncertainty we are living through, we need to build a number of scenarios and see if scenario A materializes, what is going to be my response. Likewise, we need to do a lot of what-if analysis on various parameters. Sensitivity and stress testing, extremely important to test the resilience of the businesses and projects which come our way for financing. Liquidity, extremely critical these days. And when we look at liquidity, I'm reminded of one of the terms we use, that is EBITDA, earnings before interest, tax, depreciation, and amortization. Now, is it a good measure of liquidity? I think it is not. And we are using it profusely. Earnings really do not mean that you have liquidity. So we need to, with a kind of a magnifying glass, how much liquidity is there in a store actually available with a unit, how much is on tap, he can get it easily. And stuck in the clouds, like someone says that I have a lot of current assets, receivables, etc., etc. Actually, we don't know. It might be stuck in the clouds. And how do we ensure that we are able to measure rightly? The entire approach to financial management is survival first, Because we have experienced in India that a lot of promoters use little bit of money they earn and they keep aside as surplus for funding new projects. Is that model still valid? I'm not so sure. So what is the lesson for the road ahead? Whenever as an analyst we are analyzing, we must understand the rationale for loans requested. What is the actual purpose? What is the capital intensity? How much money is going to be invested? The entire capital funding model, revenue model, leverage, value chain, and severity of impact, all this has to be studied. So essentially, it is back to fundamentals, and the models that we have created basis the data for the last 10 or 20 years. Probably they will have to take a little bit of backseat, and more application of mind by the analyst might be called for. So let's look at what else can be done, and how we can be sure that our models are working, or we are able to assess the limits correctly, assess the funding requirements correctly. So there is a need to recalibrate credit risk assessment models. And like some parameters I have said here may call for detailed scrutiny and elevated weights. For example, liquidity, equity, all these will need to be given much higher weight in our models. In case of equity, we may need to look at quality, track record, group support, demonstrated as well as current ability, and some might even turn redundant. Some parameters may be redundant. Here I would like to flag one thing. While we build our models, over a period of time, many parameters get added to that. And what happens, let me give you an example from our own human health. In case we create an index, health index, and we kind of write down everything, whether my eyes are okay, whether ears are okay, heart is okay, all of that, and assign some weight, at the end, we may not get a sharp indicator, because it depends on what kind of risk I have. If I'm a diabetic, then probably it has a different dimension. Likewise, in case of units and industry, we need to understand the risk drivers very clearly, and those risk drivers need to be given more weightage in the credit risk assessment models. Now, pace of expansion, many of the companies, they expand at very fast pace. So the structure complexity, diversification, how much shares have been placed, quantum and trade, overall borrowing. Now, overall borrowing again is very important. See, even if you have a debt equity ratio of 1:1, but your borrowing is say 2 lakh crore, it's a different ball game altogether if you are called upon to repay and refinance it. So overall borrowing is important, and we must look at it and not get kind of slayed by ratios. Now, reliance on ratios, we need to read in the right context. Now, EBITDA, for want of time, I will not discuss that, but I would urge you, in case you are interested, some of you might have read, there is a paper by Moody's on this, that how EBITDA has been popularized by the banking and investment bankers and how misleading it can be. Today, I had a chat, you would be aware of Professor Edward Altman. He works with a guy called Dr. Gabriele Sabato. So today he was mentioning that all the ratio analysis, etc., that we have been doing in the past, probably it requires a multi-layered approach. So it is important to look at parameters and indicators in combination or in conjunction. If you look at a standalone parameters, that may not give us the right context, the right lessons. So like loan servicing track record, so you look at CICs, CRIL, conduct, etc. So you also need to look at reliance on short-term debt and borrowings. Is it a case where the borrower has been able to raise short-term funds and somehow keep his account as standard? Export earnings, ECB, unhedged exposures, another example. Again, number of employees, PF, timeliness of PF payouts, etc. is another combination. And to do this, probably we'll need to use more and more of technology, more of cloud, because human mind, it might be difficult to understand all the correlations and really read the indicators in combination. So like a doctor does, you have to read the parameters and the findings in overall in a holistic way to understand the risk. And that's how I look at it post-COVID scenario, how we can handle this entire risk assessment approach. And thank you so much. In case you have any questions, happy to take.
This is to Mr. Kishora. Am I audible?
Yes, absolutely.
You would remember I had forwarded some of the questions, and I could see you have covered quite a few of them. Would you like to specifically separately take up any one of these questions and respond to that? And then we will open it for the participants to ask questions online now, live.
Right. So you just give me a sec. I will open the question.
Yeah.
It's with me. So I should be able to. Just one sec. Or if you have the questions, I can respond to them immediately.
Sure. Let me recall one of the questions was whether there is a possibility that we are actually looking at a very temporary transitional period. Something has happened. We are going to go back to the normal. So to what extent these changes are actually necessary in an enduring sense? Whether we should really make a kind of long-term change in our credit risk systems and processes, or we do it for a temporary period by some marginal tweaking, and then we are looking forward to a time when the things will again go back to the old system. There was some of one question which I found interesting.
May I respond to it now?
Sure.
Yeah. So there are two things I would like to mention. One is that in my view, and in view of the people I spoke to, we need to make some enduring changes. For two reasons: that in the past also, whatever model we had, whatever risk rating and scoring cards we had, to what extent they have been able to protect us from escalated NPAs, etc., is anybody's guess. So there was something fundamentally amiss there as well. So this is the time to correct it. Second thing is that this time, probably this generation, although it is said that public memory is short, probably we are not going to forget the lessons, and economy is going to change. The way the public leaders are pushing for Atmanirbhar or self-reliance or China plus one, changes are for sure there. The new generation, we have already been saying that millennials do not want to buy houses in their name, etc., etc. So we need to prepare for the long term. And having said that, I would like to flag that at the moment it might look like a lot of work, but once we get the risk drivers right and we use technology, it would be not very difficult to look at numbers, etc., in combination, in conjunction, and come up with right recommendations. So some trial and error, some iteration, but I believe that it is possible to get it right within, say, within max 2 quarters. So we should be readying for the long term. Second thing, that there is a talk in the Western world as well, and maybe we can also start thinking that risk as a service. Risk as a service is another concept. There is no reason now in today's world, there is nothing confidential, there is nothing kind of proprietary also, I would say. Everything is in the public domain. Given that, can we think of something like risk as a service, where we collect and combine all the data and serve all the units or industries or banks in the ecosystem?
I think the whole conversation is about a fact that somebody mentioned recently in yet another webinar, that for quite some time the credit risk assessment, and for that matter many other types of risk assessment processes were crying for changes. Like the other day we were having a conversation with you. You yourself were also mentioning that some of the qualitative parts of it, which had never been part of the credit risk assessment process, probably can now going forward form part of the form integral part of the process, regardless of whether this COVID situation remains or not. Basically, kind of taking the opportunity for a change. This change would take place in that direction.
Absolutely. I can't agree more. And maybe CAFRAL could play a lead role here as well. It's really a situation where a lot of repair and a lot of kind of corrective action had to be taken. Now is the time to take them. And as I said, using technology, we can look at multiple variables and come up with better answers. And risk as a service, probably that's another idea I think we should consider and see if something can be done.
Anything else out of the questions you would separately like to comment, Mr. Kishora?
Yeah, there was one question, I think somebody in the mail, if I recall correctly, said that how much to lend, whether 200 crore is the right amount to lend or 500 crore to real estate sector or yes, construction. So my view is that it's not a function of how much the unit or corporation needs or the company needs. It's about how much tier 1 capital you have on your own balance sheet. The bank has to fix its risk appetite in accordance with two things. One is the capital it has, and secondly, its own earnings potential. How much is its, let's say, annual earnings, and as a proportion to that, how much hit it can take. In risk literature, we often do one analysis where we say that what is the probability and what is the impact given that probability materializing. Now, this is in some ways a flawed way of thinking. Even if the probability of losing 200 crore for a small bank is 5%, if their capital is only 200 crore, probably that's not the right way to go about it. And we must calibrate our appetite according to the earnings capacity and capital we have. Another query, I think, was around our lease rental discounting, which I have already mentioned. That's a kind of a passing the parcel kind of where we are happy as bankers. But there is too much of pressure, I must agree and concede. There is too much of pressure on banks to lend. We are sitting on piles and piles of money. And those retired people and others who were kind of dependent on the deposits are getting the wrong end of the stick, I would say. But still there is no demand. So it is a very tricky situation. And this is a time where we need to use prudence rather than get kind of driven into cavalier lending, I would say.
There is one very interesting question coming in, but I don't think this is something which I will direct towards you. Can I request Mr. Sinha to respond to this question? Somebody is asking whether, in view of the evolving situation or in the existing situation, there is any possibility of RBI changing the asset classification norms.
Anyway, my personal take is you should not shift the goalpost, So, but you could have workarounds like, moratorium and things like that actually give you that leeway. Personally, I don't see the goalpost should be shifted, on account of these or any kind of temporary, temporary stresses which come into the system. But, we have other workarounds which actually achieve more or less the same thing by giving you that extra time. So, in a sense, that does get achieved through a different route. I don't know if Mr. Panda has a different take on this.
No, well, I mean, in my opinion, this could depend on the evolving situation. If there could be really a lot of deterioration takes place, perhaps it could be considered, but we are not the right person to respond to it. It's only RBI going forward would respond to it. This is a matter of speculation ultimately. But I think if the situation becomes very bad, perhaps there could be a scope or a potential. What's the take of Mr. Kishora on this?
I would agree with both of you, and see, the goalpost, I fully agree, should not be changed, and there is a deeper reason for that. In my view, this entire Basel framework, etc., NPA recognition norm, let's say 90 days, you make it 180 days, or you make it 360 days. You may say that the entire Basel framework is an artificial construct, and therefore the regulators have every right to change it. But that is probably not the real issue here. When your business model is broken, when a certain business model completely goes for a toss, there is no point clinging on to it. It is only throwing good money, and the money belongs to the public after bad ideas. So given that situation, COVID has also given us an opportunity here to do a thorough review, what cannot be protected, and the better and the sooner you write it down, the better it is for the economy. So I think temporary solutions will not work and may not really be even helpful for the banks.
There is one more question which has been framed like this, but I would slightly modulate it and I'll put it across to you, Mr. Kishora. What the question says is, the pandemic situation is something like unknown. And in that sense, how do the future stress testing and management of risk will take those things into consideration? The person who is asking this question is trying to communicate the fact that this new normal is actually not new normal, it's new abnormal, and new abnormal is not a discrete thing. Similar things would keep happening over time and again. So the stress testing thing, which is heavily dependent on some events in the past or some kind of scenario, envisaging some scenario, and then doing the stress testing, whether that is going to work or we are going to look at something absolutely new type of stress testing framework.
Actually, in my view, it's a very interesting question and may require further research. But in my view, three comments. One is that the stress testing has really evolved a lot. And I believe that it is good enough to handle even situations, abnormal situations like what we are experiencing. How do we go about it? Now, there is something called reverse stress testing as well. And in case we are company A, we look at it and see that if a stress level of 50% is applied, it is broke. And we find that the current situation, their revenues, etc., have fallen by 60% or 70%. Obviously, that company is not resilient enough. So you need to determine at what level it will fail. So once we have done that, and then we have to look at all the numbers around it in terms of revenue, profitability, cost structure, etc. And I will refer the old slide where I said, is it a case of broken business, broken business model, or broken balance sheet? Depending on that, we have to apply various stresses and see how it behaves. That is one part of it. Second part will come from fundamental analysis, where we will know that whether this business per se is going to survive, whether this business model is going to survive. So with these two, I think it is possible to handle and do the stress test without devising a new framework.
One One more question, and that question is: with so many of the red flags cropping up due to COVID-19 impact on the economy, what should be the topmost concern that the risk department should focus on? While I put this across to you, add it up with another question, which is, Mr. Kishora, something which necessarily comes in at a high level discussion today on risk assessment front. That is the climate risk, climate change risk rather. So one of the participants have put this question: do we see the climate change risk becoming the anchor of next system or next way of looking at the risk assessment? Yeah. So these two questions probably can be taken together, and you could try to convey something to.
Sure. So the first one, as risk professional, what's the key flag that we should be looking at? In my view, the answer is as follows. One is that I assume that all of us have a certain portfolio. We have lent money. So we need to look at our portfolio and do an analysis and see something like what part of the portfolio is the green zone, what is amber, and what is red. We can do a stress testing on the portfolio. Stresses have to be decided through expert judgment, and the kind of hit revenues, etc., have taken the kind of whether that sector is in high risk category, like hospitality. Hospitality, travel, entertainment have taken a major hit. They may not kind of get any revenue for the next 1 year or so. So we need to trifurcate the portfolio. Then within that, we need to look at individual companies and see what kind of resilience they have. And depending on which category they fall in, if it's a case of broken business and we are convinced, we should not hold back from lending to them additional money, provide them liquidity. Mr. Sinha in the beginning mentioned about solvency and liquidity. So the first case is a liquidity case. We must go out and help them out. Balance sheet, if it is broken, then we need to look at to what extent the company or the promoters, they would be able to bring in funding from their side. Is it going to be a kind of bank-led rescue, or is it going to be a more equitable rescue? Depending on that, a decision needs to be taken. Where the business model is broken, I think that's the time to call it a day and not get into a deeper mess. So that these are the three areas. And while we do this, we also need to look at whether there is a possibility of the company migrating into the third category where the model itself is broken. So these are the areas where we need to. So this requires a lot of agility and a thorough review of the portfolio. Many of the banks abroad and some banks in India, they do have portfolio risk management wings, and this is the time to activate them. Regarding climate change risk, in my view, and I had a chat on that today again with another banker in London, and the view is that how we were earlier looking at it in terms of 2-degree scenario or 1.5 degree scenario, etc. Now probably it's going to completely change, because this climate change, I mean, we have seen there has been active live experiment because of COVID, that what kind of impact this economic inactivity has created on, has impacted the climate. Given this, now climate is going to be a key driving force in all decisions that we take. It might come to a situation where Indian banks may not be able to get funding from European and other banks in case we do not get it right in terms of climate risk strategy. Probably we may not get funding in case we go on funding coal mines and thermal powers. So I think it will become not only a kind of a factor in our ICAP, for which we allocate some capital, but it's going to determine our decisions on a day-to-day basis. That's what I would say about climate risk.
There is one more interesting question.
Yeah.
If we are to do tweaking of models based on the current situation, it will be heavily dependent on our judgment, as backtesting may not be possible. Do we have anything else to depend upon?
Absolutely. This is a very good question. And earlier we used to backtest, we needed data for 10 years. No more that kind of luxury is available. So how do we do that? In case of model risk, as we all know, we need to maintain, update and retire models regularly. Somehow I have a feeling that in India, we have been clinging to our models with minor tweaks and minor enhancements or changes year after year. That has to change. So more active management and maintenance of models is required. Second thing is that instead of backtesting, accumulating data for a period of time and doing some analysis, now we have the technology and wherewithal to not only tweak these models, keep testing them and learning from them as machine learning does on a kind of a routine daily basis. And maybe over a period of 6 months, it might start giving you very good results. So this is possible, but we may have to give up our old traditional scoring models.
Okay. So we have almost come to an end. Just a couple of minutes. I wish we could have continued this conversation for a longer time because there are so many fascinating aspects, so many good questions coming up. And, yeah, this subject is going to be very, very, exciting and interesting going forward. We would be looking at some more deliveries on this particular topic in time to come, probably. Let's see. Having said this, Mr. Kishora, thank you very much for being with us and doing this thing for us. It was wonderful. It was really very enjoyable, and I hope all the participants would have really enjoyed it. And thank you very much. Thank you, Anu. Thank you, Puspalata. Thank you, Charulata. And we are exactly 1 hour. We thought we will do it for 50 minutes, but we are overshot by 10 minutes. So thank you so much. Thank you so much.